Markets expected a $7.8 billion surplus out of Europe. They got a deficit instead, not a small miss, a complete reversal. And that single data point is telling us something important, something that most investors with global portfolios are not prepared for. Here is what actually happened. The Eurozone released its April trade balance data this week. Analysts had penciled in a comfortable surplus. Instead, Europe posted a €1 billion trade deficit. That is nearly a €9 billion swing in the wrong direction. The culprit? A growing energy trade deficit, combined with a shrinking surplus in machinery and vehicles, two of Europe's most important economic engines, both weakening at the same time. Now let me explain why this matters to you directly. Most everyday investors hold some form of global exposure, either through a pension fund, a retirement account, or an index ETF. Many of those products hold European stocks automatically. You may not even know how much European exposure you carry, and this week's data just raised a serious question. Is that exposure working for you or against you right now? Let us start with the energy piece, because that is the most urgent part of this story. The Middle East conflict has not gone away. Yes, there was a ceasefire announcement. Yes, oil prices fell sharply last week, but the structural damage to Europe's energy supply chains runs deeper. Europe still imports enormous volumes of energy, and when energy gets expensive, European trade balances deteriorate fast. We saw that dynamic play out directly in this data. Here's the part that compounds the problem. Europe was never a net energy exporter. The United States is. That asymmetry matters enormously right now. When oil prices spike due to Middle East tension, America can hedge domestically. Europe cannot. Europe absorbs the full impact through its import bill, and that import bill just quietly blew a hole in the April trade numbers. But energy alone did not cause this surprise. Hold that thought for a moment. German wholesale price data came out this week as well. Wholesale prices rose 5.9% year over year in May. That is down from 6.3% in April. Progress, yes, but still elevated. And the biggest price increases were in petroleum products. Exactly what you would expect given the energy picture. Germany is Europe's largest economy. When German wholesale prices stay high, the cost pressure flows everywhere, into manufacturing, into transportation, into the goods that eventually reach consumers. Now back to that machinery and vehicles number. Europe's surplus in machinery and vehicles shrank. That category is critically important. It represents one of Europe's core competitive advantages globally. German engineering, French aerospace, Italian precision manufacturing. When that surplus shrinks, it signals something deeper than a trade data blip. It signals that global demand for European industrial goods is softening. And it suggests the tariff pressures building between Europe and the United States are starting to bite. This connects directly to something we need to talk about plainly. If you are finding this useful, consider subscribing for more practical financial insights. The investment case for European stocks in 2026 has always rested on two pillars: attractive valuations compared to US stocks, and a recovery story driven by stabilizing inflation and interest rate cuts. But this week's data chips away at both of those pillars simultaneously. Here is why. If Europe's trade balance is deteriorating due to energy costs, that is inflationary pressure. Inflationary pressure makes interest rate cuts harder to deliver. If rate cuts get delayed, the valuation discount on European stocks matters less, because cheap valuations only create returns if earnings actually grow. And earnings growth in a high energy cost, softening export environment is genuinely difficult. That is the trap forming right now. And everyday investors sitting in a balanced global portfolio may not feel it yet, but the data is signaling it clearly. So what does a practical response actually look like? This is not a call to panic sell European exposure. Markets move in cycles. European stocks have delivered strong runs before, and they will again. But right now there are three things worth thinking through carefully. First, check what percentage of your portfolio sits in European equities. Most target date funds and global index ETFs carry between 15 and 25% European exposure. That is a meaningful allocation. Know exactly what you own. Second, understand whether your European exposure is currency hedged. The euro has been under pressure. A weakening euro erodes your returns when converted back to dollars or other currencies. Currency exposure often gets ignored until it starts hurting performance. Now is a good time to check. US earnings have remained resilient. The Nasdaq 100 rose nearly 3% last week alone. The Philadelphia Semiconductor Index rose 5.1% in a single week. Morgan Stanley is forecasting U.S. real GDP growth at 2.25% for 2026, rising to 2.5% in 2027. The relative momentum case for U.S. equities versus European equities is widening, not narrowing. Now here's what gets interesting. This does not mean European markets are broken. It means the recovery timeline just got longer and bumpier. Business confidence in Germany is recovering, according to this week's data. Wholesale inflation is trending down, even if slowly. Those are real positives. But investors who were expecting Europe to close the performance gap with US markets quickly. This week's trade data just pushed that expectation further out. There is a broader lesson sitting inside all of this. Diversification is one of the most powerful tools in long-term investing. But diversification is not the same as equal weighting every global region. It requires understanding what is actually driving each part of your portfolio. Right now, the driver inside European equity exposure is energy vulnerability, and that vulnerability is not going away fast. The Middle East situation remains unresolved. The energy trade deficit is structural, not temporary. German industrial strength is facing genuine headwinds. None of this is catastrophic, but it is worth thinking clearly about. Because the investors who understand what they own always navigate volatility better than those who do not. That is what this week's data is telling us. Not that Europe is falling apart, but that the assumptions underneath a lot of global portfolio construction deserve a second look, and that second look is worth doing now, before the rest of the market catches up to what these numbers are quietly saying. The data does not lie, it just takes time for everyone to read it correctly. What you do with that information is up to you.